Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you go, and that's going to start out with the economic data, see how that impacts the overall markets with some market analysis, sprinkle in a little geopolitical fodder to round that all off, and then talk about option strategies we found that we could implement into our portfolio based on all these assumptions we come up with. And I'm talking about the optimal option strategy. As a matter of fact, we can talk about one today that I'm going to dig into more detail later on this afternoon. So before you go, make sure you guys are subscribing and hit the bell right next to it. The bell is what gives you the indication that I'm coming in a little bit early. So that way you can participate in these videos as well. And don't forget to hit that like button for me too, please. Thanks. All right. So economic data across the pond. We were talking about it being heading into the FOMC meeting, all of this stuff, what was going to happen. We knew we were going to see a slight increase in interest rates over this week. We got that 50 basis point move. One of the other things we've been noticing is that the economic data is a little bit fuzzy. We saw the Institute for Supply Management Services PMI number coming in a little bit better than expected. We got some mixed bag there, really. We got the revision on the service a little bit higher. The new service sector number coming in just slightly lower, but both of those are above 50, and 50 is expansion. So we are still seeing expansion in the economy, not really seeing this recessionary type of thing that we're been talking about with the inverted yield curve, all of those little signals. Still seeing PMI, which is forward looking, in expansion mode. So that is something we can at least moving forward know that we're seeing some strength in manufacturing. Well, with that strength in manufacturing, one thing we're also seeing is that we're getting crude oil to jack back up towards that 110 area. I was hoping to see us stay below this 50-day simple moving average. That would then get the bears back in full force, but not just any type of pullback that was enough to really jump on board with. And then coming into today, I was saying, keep your eyes out for the unemployment numbers and productivity. Productivity is a major number that we're going to want to look for here, because with all of these inflationary wage pressures that we're seeing, that drives down productivity for these companies. That means their profits are getting pinched as well. Margin compression is a major thing going on across businesses right now. And the preliminary labor cost coming in at an increase of 11.6%, folks. That is amazing. Productivity, that therefore dropping to 7.5%. These numbers are not great. Unemployment claims jacking up, continuing unemployment claims, or unemployment claims jacking up a little bit, continuing claims coming off a little there, but unemployment claims jacking up to 200,000, expected to be 180. All right. What does that mean? We're starting to see these discouraged workers come back into the labor force. Remember, I've talked about the levers and pulleys of this number, and it really has to do with statistics and data. The data that comes in is the only data that's measured. And one of the things is, if you're claiming for unemployment, you're part of the system. If you have a job, you're part of the system. If you get discouraged and you can't find that job and you stop looking, you fall off of this unemployment statistical data point, and all of a sudden it looks like unemployment claims are starting to go down. The unemployment rate goes down because you've fallen out of the statistical averages. Once you come back into the labor force, look for a job. Now your unemployment claims, you're allowed to look for or get claims from unemployment when you start looking again, and all of a sudden we start seeing that jack back up. Is it because we're seeing inflation, higher prices in gas? Now these folks are starting to feel the pinch in the wallet and know, hey, I need to get out there and get a job again. So that could be what we're starting to see here. And they're looking for higher wages as well. But when we see this influx of new workers here, that could actually help us temper some of this inflationary pressures around wages right now, which is actually pretty hard for a lot of companies, because if you think about when they're budgeting going forward and these budgets get out of whack, well, it makes it very difficult because of that margin compression there. All right, so let's get on with the rest of the overall markets. I think I cruised through most of the data points, and if I didn't, I'll try and touch on those as well And don't forget to comment on the side there if you guys see me miss something there. All right, crude oil, like I said, with that strength in the economic data points for the most part that we've seen there, besides the labor, the productivity numbers and the labor costs, those are inflationary, of course, but we're still seeing strength in forward-looking economic data points like PMI. PMI, although we did get the service sector, we've been seeing the manufacturing sector do very well. Well, that is what is lifting crude oil right now because of that demand aspect associated to the manufacturing. All right, notes is, I got the notes here, not the bonds for this time, but we can see that the notes yesterday started getting a little bit of a relief rally there. Bonds just sitting point step. They didn't really say anything outside of what was expected from the FOMC. We got the 50 basis point move. We're kind of right there. Bonds, notes, they don't have a whole lot of room to the upside here, folks, because of the levers and pulleys in the markets that we constantly talk about here. That is when we see that the bond price is starting to go down in value here. Let me get a pen up here so we can mark up everything. All right, so as we see price, if we look at this as being price, right, of the bonds, we know that this is price, this is correlated to price. As price is going down like this, well, the flip side of it is interest rates are going up. Well, we know that interest rates are going up. That's what the Fed's trying to do here, right? By raising interest rates on the shorter term interest rates on the overnight rate, and that carries out the curve. So we're seeing that happen right now. And with that, they don't have any room to the upside. Short calls against maybe a bond portfolio is something that I would be suggesting here. Gold starting to get that move to the upside now. Are people going to start parking money there? You remember I said folks feel like it's a cash grab where they're just stockpiling cash, getting out of equities, getting out of bonds, getting out of gold, whatever it is. It's felt like that they were just going for cash, parking it there. Not usually what we would see is moving that money over into another sector, being gold or something like that, that is more of a retainer of value there. VIX really getting that massive drop yesterday because the equities got a nice move to the upside, really in line with what was expected from the FOMC. So, the Fed going forward with this being very transparent is allowing the volatility to come out of some of this market here. So Dow Jones Industrial Average massively rallying yesterday, but falling short of the 34,000 mark that we've been talking about. We needed to get to that psychological breakthrough of this negative patterns that we've been seeing. So I don't think we're out of the woods here yet. I've been talking about it. One of the things is I was expecting in some of these other markets to test these Fibonacci's down here, 4,000 area for E-mini S&Ps. NASDAQ was the 12,500 area. We did come just shy of that, but I don't know that line in the sand, when we get lines in the sand, there's a tendency that we bring that to fruition by selling into it. E-mini S&Ps, you can see the nice big rally, almost unabated into the close. But I want to rally up to these trades that we were talking about yesterday. Sorry, pushing fast here. Uber had their earnings all set up, ready to go. They released them early. Why? Because we were talking about that Lyft thing yesterday, right before the open, how Lyft looked like it was going to be selling off. And I thought, hey, this is a great opportunity to look to sell some puts. Now, this afternoon, I'm really going to drill down on why this would be an opportune time to sell puts in something like this. But with that said, the reason why we saw Lyft probably get a nice big turnaround is because Uber came out to save the day for those folks and said that they actually saw things picking up. Their drivers were doing very well. Now, folks kind of consider Uber as who you would go to first as we would start opening up, Lyft being like your secondary job, if you will. So Uber came out yesterday, released their earnings a little bit early, started talking pretty bullish around the stock, and that got this kind of sector to turn around a little bit, which was quite nice. Volatility coming out quite massively there. So with that said, you guys remember me talking about this trade yesterday at the open. I was putting in an order. We were looking to be trading right around this area, around 22-ish, 21, 22-ish pre-market. So with that big of a drop, I was talking about the selling some puts. We hadn't had the volatility come out. So I looked at the 17.5 puts in May, sold them for 51 cents. It felt like, folks, I got run over because it was right off the open. And if I go flip this to a daily chart, let's break this down into a 15-minute chart. I got the overnight area. So we can see right off the open is where I had that order in there in the May, what was it, the May 17.5 puts that I had sold. And I sold them for 51 cents, putting my break even right around 17. All right. So that said, the reason why I picked that 17 area is because it was so conducive to basically, if I go out 3 years even, to where we were very close to pandemic type area. I don't think that we're going to continue to see that kind of low user rate here for these folks. So that would be an opportune time to buy when they were at their all-time low for the most part since they've got wind. So playing that to the upside, I thought was definitely worth the risk reward. Sell some puts that I'd be willing to buy. The stock at that level, right around 17. And then I got lucky with Uber coming out, though. Maybe giving them that boost at the upside. Hey, I'd rather be lucky than good a lot of times. So the sell-off there happened. One of the things with this trade is I'm going to really dig into this later on this afternoon because I'm doing the webinar on the short puts, right? So we are going to use this lift as an example this afternoon because it's a little bit, it doesn't necessarily fit my rules for the most part here. I'll just give you guys a bit of a slideshow here for a little teaser because it's so important here from current slide, folks. All right, here's what I'm talking about. And we started setting this up for the this video here and looking to sell those puts. I just guess I got this out of order there. Not really sure why those are there. So, you know, I wanted to have something different in there. Anyway, these are the puts we had sold. Talked about this yesterday, 51. Now, one of the things I wanted to show was the high low, and I guess I didn't get it. 61 cents was the high here. So with that said, you can see I put that order in right off the bat. Sold them at 51. I think 61s traded. It almost looked like they traded before my 51s. It happened so fast. But that was on the sell-off, those deltas going against me. I sold puts. I've got a bearish move happening. Well, what else happened on the flip side of that was this volatility coming out so massively. We went from basically trading around 87 in the volatility. By the end of the day, it traded all the way down to 73. So all of that volatility coming out of those premiums offset this directional move to the downside. So while we opened right here at around $22.50, we settled below that by almost a full dollar. All right. Meaning I had sold puts, market sold off, right? Volatility collapsed. This trade went up against me for maybe 5-10 cents. But folks, with this type of directional move against me coming all the way down and trading 20, all right, we were watching those premiums come out. I mean, you guys were watching this video yesterday. I know a lot of you guys are returning folks. Well, did you watch that off of the open? We were watching this underlying drop, and the premiums were kind of holding steady. They were a little bit jukey, but they did end up dropping while this underlying was falling down. All right. Uber saved the day. I'm not going to lie, coming out and saying, hey, we're not doing that bad. As a matter of fact, their guidance can't be this bad because of what we're seeing in the overall markets. That got this market to turn around, probably even got more volatility to come out of it. But that said, this is one of those examples of being absolutely directionally wrong, but turning the tables into our favor by setting these strategies up correctly at the onset. Folks, that is one of the only things that you can do to really determine whether or not you're going to be successful trading is how you set up your strategy at the beginning. The rest of it is usually to the markets. But at the end of the day, if we can get a couple of these levers and pulleys in the options to work in our favor, theta, right? We had even theta working in our favor overnight coming into today. We got that massive theta deduction. So all of those things are working in our favor. Volatility came out. Well, I could have done a little bit better job picking the directionality, of course, but that's not always what happens. Well, we don't always know if we are catching that bottom in a situation like this. So that's why we need to set these strategies up correctly so that we do it in high volatility. We know we're getting extremely high premiums for selling options. And I talk about how you can spot that quite easily in the video this afternoon on Thursdays. So please don't forget to smash the like button and subscribe with the bell. All right. So Lyft, I'm going to be looking to get out of this trade today. Sold it for 51 cents. I'm looking for 11 cents to get out. Usually I say, hey, if I can get out for a nickel, I'm going to be more than happy to do that. With this trade, it was one swing and it was basically a home run hit. So I'm going to pull the ripcord on this trade. I don't want to see this turn around and have this winner turn into a loser, especially when I've made basically 80% off the premiums there. All right, so that's all I've got, you guys. Make sure you guys check out the video this afternoon. I'm going to be doing it live, and I'm going to use this as an example towards the end because, I like to use real life examples, and they don't always go in our way. I'm not going to be the guy that says, hey, I'm going to pick the directional assumption all the time. I might pat myself on the back like this last couple of months where we've gotten this correction and calling these market moves, but I'm not always right, just like this. It's going to go against me a few times, but as long as I know I'm setting these up consistently, being mechanical about my trades, then I can keep my powder dry, stay in these trades and not worry too much. Just like this one, free falling by an extra $2.50 from the open. Folks, I sold puts. It dropped $2.50 from the point I sold those puts. And I'm up money right now. If you can't take that, take it easy.